The next panel is a panel on decarbonizing aviation with SAFs. The speakers will be tackling cost, demand, and feedstock scalability for sustainable air travel. So please welcome me in joining our expert panelists. First is Josh Dienstag, Chief Investment Officer at Carbon Direct Capital. Next, we have Saurabh Kapoor, CEO at Metafuels. And for our moderator of the discussion, Benjamin Tincq, founding partner at Marble. Welcome, Benjamin. Thanks, guys. Enjoy your discussion.
Thank you. Good morning, everyone. How are you? Can you hear us? Great. We're here to talk aviation and how we can decarbonize aviation. So I'm Benjamin Tincq. I'm one of the founding partners of Marble. We are a company which creates climate companies, a venture studio, headquartered in Paris, but operating in Europe and the US. And I'm really excited to talk about this topic because aviation is one of the notoriously most difficult sectors to decarbonize, but it's also one of the sectors where we see the most activity on demand, on policy, on exciting technologies being brought to market, on projects being built. And we're going to cover all of that today. I have two fantastic speakers to cover that with me, so I'll let them introduce themselves. So maybe Josh, you first, and then Saurabh.
Thanks, and thanks for being here. I'm Josh Dienstag on behalf of Carbon Direct Capital. We are a New York-based growth stage investor in carbon management technology companies. The current fund out of which we invest has made a number of sustainable aviation fuel technology investments, including in the e-fuels, alcohol to jet, and Fischer-Tropsch-based fuel verticals. And excited to be here.
Okay.
Saurabh?
My name is Saurabh Kapoor. Very happy to be here. I'm the CEO of a company called Metafuels, located in Switzerland. We are the only startup worldwide developing technology to produce SAF from methanol. We are both an eSAF and a biosAF player at the same time, depending on whether you use biomethanol as a feedstock or e-methanol, and this is something that's interchangeable. So once you install a plant, you can always play in both markets. What we focus on is getting SAF costs down. So our target is to be the lowest cost eSAF producer. We achieve that through very high selectivity and efficiency towards SAF, so not trying to have any other byproducts which might have a market today, but certainly not tomorrow. Coming a long way in our journey, so we are moving away from technology development slowly into capacity building. I'm happy to be here.
Great. Exciting to have you both on the panel today. Great. So, Saurabh, you introduced a bit biosAF, eSAF. We're going to talk about the technology soon, but first, I'd love to start top down and start with demand, because SAF is a sector where we see a lot of demand already happening. So maybe Josh, why don't you start by painting us a landscape of SAF demand today across, corporate demand, policy, and all the drivers that accelerate SAF adoption.
Anyone hear me? Let's just start at the highest level. There's not enough SAF. So 80 billion gallons a year of commercial jet fuel is bought by airlines for global travel. About 0.1% of that is actually sustainable. So let's situate it. I think the answer was there was limited demand for SAF historically. The inflection in demand creation you should frame through two corridors: voluntary commitments and regulatory or compliance commitments for SAF. And obviously the level of demand pull is different depending on if you're a carrier making a discretionary or voluntary commitment, or if you are a regulated party or an obligated party. So we're seeing demand for SAF inflect off a base of zero. I would point you by corridor within the compliance part of the demand creation story is the hottest area. So, I think everyone knows the UK SAF mandate passed into law in November, which creates a forcing function, especially for United Kingdom-based carriers to buy SAF. And so it's not an accident that the maiden long-form offtakes being signed or signed in the fourth quarter of last year were in response to that TD policy. So I think we see the UK carriers leading demand creation for SAF right now, with European and American carriers at a more limited level as we see it. The more forcing functions, the more you'll see offtakes.
Can you maybe like double click on the UK SAF mandate, exactly how it works and like what's the exact?
Yeah, I think it's really important to go through the minutia of that policy, but like what they're trying to do is decarbonize the fuel pool. And there are explicit SAF blending targets, like 10% by 2030, and I believe 30 or 40% in the subsequent decades. And the stick is a carbon tax for every gallon that you consume that is not sustainable. Just the math, the policy is quoted in like $1 per ton emissions, but to make it simpler, fossil jet fuel is $3 a gallon. If you convert the units, the carbon tax or the cost of non-compliance can be as high as $23. So you can either buy fossil fuel and pay a big tax, or you can buy a sustainable fuel. I don't want to get into confidential information, but I think it's relatively known that the price of contracted SAF is lower than $23 a gallon. So all the carriers are just being economic actors, and there's demand to pay less than the regulatory tax and more than fossil fuel. That's essentially the mechanism. I'd also point out that the UK is very descriptive of what kind of feedstocks you can employ to meet your compliance regulations. So there is a HEFA cap. HEFA would be the fats and oils based SAF. So the regulator is telling the airlines they do not want them to buy that type of fuel because that has a limited feedstock. So they're effectively telling the airlines to buy e-fuels and Fischer-Tropsch based fuels,
Right,
to meet that requirement.
okay. And the one I'm more familiar with is the EU SAF mandate. Like how would you compare them and how companies react to these two mandates?
Blending requirements and targets with less teeth. What would you say?
That's a good summary. What about you, Saurabh? What do you see on the market on the off-taker side?
So we have, over the past 2 years, been talking to airlines all over the world. So, things have changed over the last 2 years. So many companies set up their targets to only dilute it later as they enter the market. The action, as we see, is happening in markets where there is clear regulation and a mandate in place. That's in the EU, Switzerland, UK. New mandates are coming in Japan, and Singapore has a ticket levy of them. Apart from that, it's all a lot of talking but less action. Europe's different. The SAF mandate went live as of 1st January, and it's been done quite smartly in the sense that if you're required to mix 2% fuel, 2% SAF into your jet fuel mix, there is no excuse to say that's quite expensive, because that's a way to prime the industry, because if the first projects don't happen, subsequent projects would never come. So 2% is not going to change something in a balance sheet. But within Europe also, there are differing views. The mandate actually applies to fuel suppliers, less to airlines. So airlines can take a view that, we sit tight. We let companies that are active in oil and gas or fuel logistics to make sure they meet these requirements. But at the same time, we see like two camps. There are airlines that are taking a lead position and other airlines who are following. And the lead position airlines are basically saying, it's our license to operate that's more at risk. And if we don't take proactive steps now, looking at how these mandates are going to ratchet up in the future, we will be the ones who will be suffering. So there is a small set of large European airlines like IAG, KLM, Lufthansa, where you see something is happening. And there is primarily more around how can we play a role, keeping in mind that we don't really need to do it, but more like developing longer term relationships to make sure we have sufficient quantities of SAF beyond HEFA available in years to come. And this is like more of a trend we see. The mandates are actually making sure actors help. Voluntary markets come on top. They do help, but without a mandate, I would not see significant quantities of SAF being picked up anywhere.
Yeah, I'd echo that. As a bottom-up fundamental equity investor is like, show me the contracts. We lead or participate in rounds when there's clear commercial proof and booked revenue. I just direct everyone to the public information that IAG, the holding company of British Airways, has signed long-form 10-year offtake contracts with companies like 12 and Infinium. And this is, we'll buy 20 million gallons a year, each year for 12 years. And this is hundreds of millions of dollars of potential contract value upon delivery. The cumulative offtakes are in the billions. I'll bank on that. Everything else is, to your point, show me the commitment.
And this is super helpful. I'm sure a question that many have is what's the typical price on these kind of offtakes today? Like how much do airlines and others pay for SAF? What's the premium, and how do we see that evolving as the market matures?
I can start. So, these are somewhat confidential information, but just go back to the overarching comment that this is a supply-constrained resource. It's an economic argument. Fossil jet fuel's at $3. The carbon tax is at $23. You should assume that the price of SAF is clearing much higher than fossil and lower than the carbon tax. And I think there's anecdotal evidence in the public domain that it's kind of double-digit dollars per gallon for SAF for a small quantity of a supply-constrained resource. The other way to triangulate it is thinking about the cost of production to make the fuel. The producer's got to make a markup or they won't build the project. And there's a number of publicly published estimates, including by our firm, about the cost of producing different types of fuels. I'm sure Metafuels will screen low on that horizon, but it's between $5 and $12 a gallon, depending on where you make it, which policy regime, and which technology you use, and they're selling it for more than that. I'd expect that the whole complex to come down a cost curve over time, but again, it's a supply-constrained resource for the time being.
Great.
This is largely what we see as well. So these discussions can get quite philosophical. What are you trying to benchmark with? What you're talking about? Fossil kerosene price of today, fossil kerosene price of tomorrow, 5 years. Are we even allowed to burn it, etc., etc.? So we basically focus on Europe. A decision has been made to decarbonize aviation. There is sufficient regulatory clarity to get those investments in, and our focus as a tech company is basically to be the lowest cost producer of SAF and make sure these valuable sustainable feedstocks, sustainable resources are put to best use, so minimize their consumption and get the best output out there to be always efficient.
Great. Thank you both. So let's talk about the technologies a bit and the different technical pathways to make SAF. So sustainable aviation fuel is a drop-in molecule, drop-in fuel. And you can do that through a bio route, meaning taking sugars or fats and processing them to make fuel, or you can make it through the eSAF route, where you take hydrogen and CO2 of low carbon origin, and you make the fuel. And there's different flavors and pathways to do that. So maybe Josh, starting with you, how do you see the different pathways to produce SAF, and what are the ones you're most excited about or that you've invested in that you want to talk about?
Yeah, no, thanks. And I'll make sure to repeat our framing. We're a growth stage investor. We're investing out of a 10-year fund, and we're trying to exit well before then. So our prism is around right now who can deliver economical and low carbon fuel. That might be a different prism than a strategic investor or an earlier stage investor. So I want to disclaim that. I'll also warn the audience, if you're going to get pitched a number of novel and new pathways for sustainable aviation fuel, and every early stage startup has an incentive to quote the lowest possible cost of production. You've got to take that through a FEL 1, 2, and 3 and a true engineering study to actually validate those assumptions. So again, I think we try to emulate the airline decision makers who we talk to as part of our fundamental due diligence, and they want to see, not only the techno-economics, but if you demonstrated it in a commercial setting. So again, through that prism of like who can deliver real fuel against a contract this decade, I think, I direct everyone to the McKinsey report. It's pretty good. There's probably 4 predominant pathways to make sustainable fuel right now. It would be HEFA, the fats and oils-based SAF. It would be the Fischer-Tropsch-based fuel, so taking municipal solid waste or biomass, gasifying it, putting it through Fischer-Tropsch conversion. It would be ethanol-based pathways, which you might colloquially hear as alcohol to jet. So upgrading ethanol into SAF. And then the final one would be the whole power to liquids or e-fuels family, green hydrogen and biogenic CO2, again, upgraded through Fischer-Tropsch into SAF. Those are the big 4. As climate-focused investors, we also look at the carbon intensity of those high TRL fuels. I think our firm feels strongly that fats and oils is a supply-constrained resource, and there are climate justice considerations when thinking about the scalability of that camp. So, I kind of told you, like, our firm is focused on the latter 3. So I think ethanol, waste, and CO2 and green hydrogen are predominant parts of the solution, and I know there's other pathways as well.
Saurabh?
Yeah, so I largely agree with what you say. We selected methanol to jet for a reason. So our starting premise was that the future of e-fuels or biofuels would be dominated by SAF, primarily because there are better means of decarbonization terrestrial transport. So you clearly would need some gasoline for old-timers and Ferrari drivers, but not for the mass commute, because you've heard Elon Musk say it very often, even if he's not popular nowadays, what you can electrify, you should electrify. If you can't electrify, go to hydrogen, and you've already lost 30% of the energy. And if you can't use hydrogen, then go for E or biofuels, you lose another 30% of energy. So sectors where there's no alternative, you use e-fuels or biofuels. Sectors where there are alternatives, over time, other technologies would win on their own. And this is what we focus on at Metafuels. So like 85% of what we produce is SAF. So we lose very little carbon and hydrogen to byproducts, which gives us that significant cost of production advantage, because you're not like forced to sell products which don't have a market or which won't have a market at prices not fairly representative. The other important thing is these are now new times, so we don't have those concentrated fossil fuel sources. Renewable energy is not equally abundant, and it's also distributed. Sustainable carbon is also distributed. So technologies that develop have to have a path to achieve scale. SAF is a 400 billion liters market by 2050. Methanol also gave us that advantage because it's liquid. It's already moved around the world at the moment. So you could easily imagine, like, we live in different cities. There is a waste to energy municipal plant. It has a certain amount of sustainable carbon. You can tap that carbon, produce methanol at small scale, but then you're able to ship it around to aviation centers and convert to SAF at a much larger scale. If you do technologies which are gaseous, you have to go the entire value chain at one location, which makes the whole thing less scalable. So basically trying to look at energy systems of tomorrow and see how can we play our role.
Great. And question for both of you, what is the right mental model to have to evaluate these different pathways? So whether it's carbon intensity, feedstock, security and supply, like how do you analyze the scalability and potential of these different pathways?
Yeah, and this is what we do all day at our firm. I think, the airline evaluation criteria, I think, are good guideposts, and then I'll overlay as an investment manager in addition. But I honestly think it's the tech readiness is the number one criteria. Can you deliver the fuel, and have you already done it? Even if you're not the lowest cost provider, I think that's the number one thing. I think if you look at what British Airways, who they've partnered with, for instance, they've signed an offtake with Infinium. I'm not sure Infinium is absolutely the best first principles, lowest cost provider of SAF. It doesn't matter. They can actually deliver it. So I'd point to that first. I think the sort of techno-economics and the cost of production is probably the second. This is a cost-sensitive endeavor, and there you're doing quite detailed analysis of the capex per gallon and the opex per gallon, and looking at the different pathways, specific trade-offs, which I think you've just addressed. And then I think the third evaluation criteria is the carbon intensity. Not all fuels are created equal. Like in the ethanol-based SAF, depending on what generation of feedstock you use, the NCI is lower or higher, especially for, I talked about voluntary demand, so corporations that are buying sustainable fuel because of a climate commitment. Well, 1 gallon of fuel does not count equally towards your climate commitment if it's higher or lower carbon. So I think those are the big three that that we hear from the airlines that they prioritize. As an investor, we need all three of those things and more. I mean, we also look at the valuation of the technology topco we're investing in. They're not all the same, let alone the governance and who's around the table, with us as co-investors. But yeah, we have dynamic competition for capital across those 5 evaluation criteria, and we've made multiple investments along those lines.
Saurabh, how does Metafuels perform on this evaluation criteria?
Yeah, so I'll first just extend on what Josh said is our direct experience with airlines is also quite similar, and I'll break these discussions into 2 parts. One is, okay, what do we need to do today to fulfill our mandate? That's something some airlines do on their own because they are an airline as well as a fuel supplier, and some just rely on their supply chains to make that mandate happen. But the second more important discussion really is license to operate. If you want to buy longer term from a technology or a company or want to invest, it's more about we accept that prices today are high, but what we need to be convinced about, where the journey is headed to. How can you demonstrate that as the industry scales, as the whole value chain scale, we are able to achieve SAF costs of production, which keeps us alive. And the other part is often airlines take a more than required aggressive approach on carbon intensity. So there might be a certain requirement from a regulatory perspective, but most airlines we talk to even go beyond that and say we need a target of our own. So what we are trying to do is actually address this thing. We have our first production projects currently under development. They will enter production 28 in time for the step change in the European mandate. There will be a certain cost of production for these first projects, but what's very encouraging for us is these costs of production at a suboptimal scale are still significantly lower than reference prices European Commission published on how penalties are going to be calculated. And then the longer term clearly demonstrating what's the path ahead in terms of the whole value chain scaling, how cost of capital comes down, how big scale plays into, and what role governments can play in making these projects more competitive.
It's a really good point and a good amendment to my remarks. The airlines are looking at the cost down. I mean, I don't think the carriers are excited about paying double-digit per gallon over time. The point is the suppliers, they're trying to buy their way down the cost curve along with the suppliers. So yeah, it's like whoever's got the nth of a kind, lowest cost provision is a good partner to eventually lower your fully loaded cost of fuel.
Do you think there are like some pathways that will make more sense in some regions than others? Because, for instance, the US has a lot of ethanol, Brazil as well, so you can see a coal to jet working well. So does it depend on whether the region has abundant ethanol, sugars, electricity, hydrogen? Like, how do you see that? It's pure pragmatism. Just find the lowest cost, most friendliest place to produce the fuel. You got to ship it across the pond to the UK anyways. I would echo, Ben, all of the variables you said. You need abundant feedstocks. So yeah, I mean, there's real SAF production going on in the wood basket of the southeast United States and Louisiana, or wherever there's an abundant ethanol or abundant biogenic CO2. But it's also policy incentives. Abundant feedstock, cheap renewables.
but favorable policies such that making it on certain soil is lower cost than making it on other certain soil. So I don't think it's an accident that 3 or 4 of the premier and leading and largest sustainable aviation fuel plants are in the United States. There's no patriotism to that. There's the 45V and 45Z SAF production credits that are an incentive to produce locally. I think you just sit there with a calculator and look at what's the lowest cost place. So there could be, like for instance, in the Middle East, there are certain operators looking at situations where there's no policy, but there's very cheap renewables. Yeah. So I would just take a very pragmatic approach. But right now, I think the United States is probably the cheapest path, the cheapest fully loaded place for a number of different technologies.
Will these credits still be here in a month from now? Difficult to predict these days.
And to your point, I mean, if the policies were to be amended or changed, the operators will dynamically recite the next production location. There is no allegiance to any beyond the sunk cost that's been employed during the feed process to re-domicile if there is a lower cost of production.
Right. And what about you, Saurabh? Like, do you see like methanol to jet as a universal pathway from a geography perspective, or are there like for the production you target like specific regions where you can access cheap, clean methanol, and that makes sense for your process?
I'll first just expand on what George says. We often hear campaigns like we have to have energy independence, we should have our own power to liquid or biofuels projects in Europe. And this is for me all ill-placed because we also buy a lot of petroleum-based kerosene from somewhere outside it comes. So there's no point doing PTL, let's say in the UK, for example, or Denmark or Norway, if you can't get competitive cost of electricity, right? So these things would move around the way they traditionally move. So what we look at when we develop our projects, look at site is it's a two-pronged approach. For our first-of-a-kind projects, we are really looking for regulatory certainty. So where would it make sense, where I de-risk and where the lowest cost of production is important, but not criteria number one. What's important is that these projects get built. They get built in a project construction which is relatively simple, not going too complex. But beyond that, for second, third, nth-of-a-kind projects, we really operate globally. And we have multiple levers. If I can be specific about Metafuels, methanol clearly would be distributed. It's going to be all over the world. What we need to decide is, do we convert it to SAF where methanol is produced? Or do we use something like hub and spoke where methanol is shipped from multiple facilities to, let's say, an aviation infrastructure hub, like our project in Port of Rotterdam. We will be getting methanol from North America, but converting it to SAF there. So you have the possibility to play in these markets. And again, I would request these requests like, let's be energy independent. That probably would not hold for too long because this would be global supply chains.
So let's talk about first of a kind. You just touched about that for a moment, Saurabh. What does like the scale up and financing and capital stack journey look like for Metafuels? Like, what's the playbook you're following to build your first of a kind?
So what we are doing at Metafuels is something we have done before, like how to develop new technologies, how to scale them up, how to think about financial risk, how to think about technical risk. So when we set up our program, we basically started from the largest projects we're going to be building, and then basically came all the way back to our pilot plant. What should be done at pilot plant, in what form, in what environment, to de-risk the whole journey. Where we stand today is we have our tank-to-tank demo plant. Tank-to-tank, I mean starting with a tank of methanol and ending with a tank of jet fuel in final stages of implementation in Switzerland. So we would be starting commissioning of this project next month. That would be a significant step for us because we took great pain to design this project in a configuration which is very similar to how large-scale projects are going to be built. As we implement these projects, we have been developing first-of-a-kind and growth projects in parallel. Our flagship project is a 10 tons per day SAF project in the port of Rotterdam. As I said, we will be interchangeably using biomethanol and e-methanol because this project comes into operation mid-2028. It's in time for the next step change in the SAF mandated quantities in Europe, but one and a half years early for the e-fuel cell mandate. So can you imagine initial 2 years we produced more biosaf than eSAF, but in 2030 we switched to E. Again, it's 10 tons per day. What's important for us, and this is something I've done previously in my life, is make this project simple. So there are many projects who look like super optimum on PowerPoint. Josh can talk about it, but when you actually look at it in deep thoughts, yeah, there are too many dependencies on other players. It's quite a complex construct. So we're really talking about simplifying the project, have less interdependencies on counterparty, and make ease of execution, ease of development, have priority over the best cost of production. This changes in subsequent projects. Subsequent projects are then more commercial, and we really have to focus on achieving the lowest cost.
Thanks, Saurabh. What about you, Josh? You've seen a few of these projects scaling up, and what does the scale-up and financing journey looks?
So let's put it in context. Like, this first-of-a-kind thing, it's a problem, okay? But it's a good problem. So remember, we didn't have any demand for SAF 5 years ago. Now the demand signal is there and the offtakes are there. So now we get to have the good ecosystem problem of building the real first generation of commercial scale plants. And remember, this industry already exists in jet fuel refining at grand world scale. So everyone knows where it has to get. And the first of a kind is a real chicken and egg because, as we all know, it's a concessionary risk return profile. It's a lot of risk. There's binary risk before the project reaches final investment decision. Nobody wants to do it. But if we would just get to second of a kind, there's like endless demand for capital. So the industry is solving this first of a kind problem in real time, and I think you just heard a solution. I'll just give you 3 buckets of how these first of a kinds are getting over the line. And again, this is like we're going to spend hundreds of millions of dollars to produce tens of millions of SAF. I think we see 3 things. We see technology companies have access to capital and raise venture capital rounds, which they then use to build a project, which is essentially what you're doing. Then we see independent developer groups trying to raise money to do a first of a kind. And then we see projects not getting done. Those are the 3 verticals of activity. I think the independent developer groups trying to raise money, including franchisees of licensees of different technologies, it's not easy to raise this capital. You're asking people to raise dedicated first-of-a-kind capital. Like our fund doesn't want to do that. I think the most successful case is that former camp, which is the tech topcos do have access to capital. And it's not an accident that companies like 12 or Air Company or LanzaJet or Infinium, they're raising big VC rounds and they're just building the first of a kind. And no, that's not the most efficient cost of capital. I mean, you're raising 25% IRR capital, building a 0 to 5% IRR project. But this is sort of this is what it takes to get things over the line. So the folks at those tech companies putting money in see the broader picture of if we could just get past this first of a kind, it opens up really attractive corridors of capital. I definitely point to TPG led the Series C in 12, which another tech topco that's building a first of a kind, and I think they see this playbook and see subsequent deployment capabilities in 12's technology after the first of a kind.
So one thing to add, what we observe changing is this ecosystem is also emerging. So what we are trying to do at Metafuels is already also think about second of a kind project and actors for whom second of a kind projects interesting. And also, as Josh said, we bring something unique, which is our technology. We are not a generic developer. What would it take to already involve them in first of a kind projects? So it might be a small first step, but if they can already do that, then it secures their access to second of a kind projects. So that's something quite important. The second aspect is in the backdrop of European mandates, it's actually possible to have a profitable first of a kind project in Europe. You don't need to be losing money. A good technology actually helps you with that, but still, if you have a right set of partners beyond that initial optimization, stabilization, you can make money with FOAK projects as well.
Cool. Thanks a lot for that. I'd love to get your take maybe as a final question before we turn to the audience on what are you looking forward to on the horizon and what could be transformative for the SAF sector, whether it's novel technologies, new pathways, new feedstocks, market shaping. I mean, happy to start and maybe with a shameless plug. So we build companies at Marble. We have a company called Helium. They're making very, very cheap low carbon methanol, maybe future feedstock or partner for Metafuels. So really excited by the new molecules, new feedstocks space. Geologic hydrogen is another one that is being talked about a lot these days. That could be really dramatic to down cost hydrogen, clean hydrogen to $1 per kilo. But there's many others. So what are you looking forward to on the horizon, both of you?
So maybe have a go first. So for me, two things are important. One is regulatory certainty and long-term regulatory certainty, and not just in Europe, but also beyond. Clearly, it's wishful thinking. But if we see those first signs from Europe that European regulations stay put, what European Commission has been doing over the last months continues, this is the place for us to be. We would rather not go to other markets where things go up and down because it's very difficult beyond that. The second aspect is what we do methanol to jet, we are best in class, even when you compare us with larger companies. But this is a value chain. So what I'm looking at is what you just mentioned, you know, the upstream value chain and downstream value chain. How can this value chain improve? It could be companies like Heirloom, electrochemical ways of producing methanol, or simply stuff like electrolyzer efficiency improvements. These things go a long way in making us competitive as well. Josh.
Yeah, I don't think the bottleneck here is a technology problem. It takes like 10 years to build up the IP and technology readiness to even contribute to the SAF supply solution. I think we get plenty of technologies that need to scale. So I think the thing that we've got an eye on is kind of the dovetail to is capital partnerships. We need the traditional real assets capital that has a lower cost of capital to come in at the second of a kind, and it's happening. So kudos to Brookfield, who have made project level, admittedly after FID commitments to companies like Lonza and Infinium and TPG to making commitments in 12. So if you have real big private equity money that will be there for the subsequent deployment, that takes the dilutive onus off the tech companies who candidly can't raise billions of dollars to build projects. So we need the cost of capital is, I think, the big constraint. Incrementally, there are additional revenue opportunities for these projects to make them more attractive to the powers that be. It's not juicing the technology, it's making the projects more fundable. So, there's the nascent ability to additionally sell Scope 3 attributes in addition to selling the fuel, effectively upselling, is a novel product that our firm is a little bit involved in helping facilitate. But if the project makes more revenue than you underwrote, it's easier for people to underwrite it.
Great. Thanks a lot, both of you. I think we have time for a couple audience questions. So there should be a mic somewhere in the room. So please raise your hand if you want to ask a question to your panelists. Yes, here.
Thank you very much for your presentation. My name is Christian. I'm from the European Bank for Reconstruction
Can you
and
put the mic
Development.
Yeah, perfect.
Right. So I have a question for you guys. Give or take ballpark, what is the total investment cost for a SAF manufacturing plant? Imagine a greenfield installation.
The same as a fossil jet fuel plant. There's a technology core and then outside and a ISBL on top of it. It's hundreds of millions of dollars to up to $1 billion, depending on the scope of it.
Thank you. Another question? Yes, just here.
The question for Saurabh, if I'm pronouncing correctly, sorry. So what is the renewable methanol cost you're targeting for SAF to be competitive today and tomorrow?
Yeah, so if you were to do a desktop assessment and say, with our technology, methanol to jet, what does it take to meet, let's say, 80 cents a liter on fossil kerosene? That would be a renewable electricity cost of 30, 35, 40 something like that, dollar or euro per megawatt hour. We are not there yet anywhere, but we could reach there. The important thing is always be very efficient with the use of these resources, and then the whole value chain has to improve and scale down.
Great. Yes, question on the back.
Another question regarding methanol to jet. What do you think are your main competitors as methanol off-takers, and do you see a risk of losing methanol against other off-takers?
Yeah, I get asked this question very often. The big challenge is not methanol. Methanol is just an energy carrier for us. The big challenge is always where is the renewable electricity going to come from and where is the sustainable carbon going to come from? Because I can easily decide to synthesize methanol in my plant as well. So the question should more be, what is the competition for renewable electricity? Yes, it's cars. Yes, it's the whole electrification of system. Methanol per se is not something that bothers us. Yes, there is currently demand for methanol for shipping, but a large part is because of aviation, primarily because of mandates in place.
Great. I think we are just at time, so thank you, everyone. Thank you very much, Josh and Saurabh, for your time today. It was a pleasure, and have a good rest of the day.
Thanks, everyone.
Thank you so much.